Okay, so let's start. We want to start a new topic now. And our new topic for now is the topic called published accounts. That's the new topic we want to do now. A topic called published accounts. So let me introduce it. Now. Now, whenever you are a public company, it is required that as a public company, you should prepare what we call published accounts. As a public company, you are normally required to prepare what we call published accounts. Okay? So, what should you include when you, as a public company, are preparing your published accounts? What should you include in that complete set of financial statements that you prepare? In other words, what are the components of a complete set of financial statements? The following are the components. In other words, whenever you are preparing your published accounts, in your published accounts, you are required to include the following. One, you are required to include a statement of financial position. As a company, in your complete set of financial statements, you are required to include what we call a statement of financial position. This is also what you could call balance sheet. Okay, that's one. The second component you should include in a complete set of financial statement is what we call the statement of profit or loss, and other comprehensive incomes. Statement of profit or loss and other comprehensive income. Some books will call it income statement. Others will call it statement of comprehensive income. Whatever it is that they are calling it. That's another component which should be included in a complete set of financial statements. Number three, another component of a complete set of financial statements is what we call a statement of changes in equity. We shall look at that later. How does it appear and how do you prepare it and what it is? But just for now, just know that you are required to include a statement of changes in equity. Number four, another thing you are required to include in your complete set of financial statement is what we call a statement of cash flows. Of course, in your financial accounting, you did cash flow statements. The same, you should include that statement of cash flows. Another component you should include is what we call accounting policies. You should include in your complete set of financial statements, you should include accounting policies and explanatory notes. We shall see how to prepare them and what are those explanatory notes that you should include. So those are the components of a complete set of financial statements for publication. Listen, for publication purposes. When you as a company, you are a public company and you're required to prepare published accounts, these are the 5 components. Of course, you have been asked in the past papers to state what are some of the components of a complete set of financial statements. We have said there are 5. 1, statement of financial position. 2, statement of profit or loss and other comprehensive income. 3, statement of changes in equity. And number 4, statement of cash flows. And finally, number 5, you should include accounting policies and explanatory notes. Accounting policies and explanatory notes. Okay, good. Now, for some of you, today being a free lesson, listen, today being a free lesson, for some of you, it is your first time. It is your first time to join us. So I want just to explain something. This is especially for the new students. Listen carefully for the new students. Sometimes when you're watching a live class, you may be disconnected because of your Wi-Fi strength being weak. Okay? In case you are disconnected, listen, in case you are disconnected and you try to click on the disconnected video and it doesn't bring you back to class, listen, if you click the disconnected video and it doesn't bring you back to class, then there are 2 other ways to come back to class. One is you can click on what we call the refresh button. Normally, on the gadget you are watching the page, this video from, either on the top left or on the top right, there is always a refresh button. So you can refresh the page. In case you are disconnected, you can try and refresh the page. If your gadget doesn't have it, then the other way to come back to class is to go back to the group where you received the link from, and you click on the link again, and you click on the link again. Okay, good. So that is just the modality of how it operates. In case you are disconnected, how to come back to class. You try to click on the disconnected video, it doesn't bring you back to class. We are saying refresh the page. That means use the refresh button either on the top left or top right of your page. If your gadget doesn't have it, then go back to the group, click on the link that was sent to you. Click on the link that was sent to you. Okay. Also, maybe before we continue, listen, for all students now, maybe this is an appeal for all the students. Please subscribe. Please subscribe to my YouTube channel. You can click on the subscribe button down there. You can click on subscription button down there to be a subscriber to my YouTube channel, so that whenever I post videos in the YouTube, you will be able to be notified. So you click on the subscription button, and you can even click on that notification bell. You can click on that notification bell. So that's just an appeal that click on the subscribe button on that page, then click the notification bell. That means you subscribe to my YouTube channel. Okay, that's just an appeal. Please subscribe. Now let's go back. Let's go back now. So we want to look at, now listen carefully, we want to look at how do you prepare each of these components for publication purposes. How do you prepare each of them for publication purposes? For now, I want to start with, listen, I want to start with how to prepare the statement of profit or loss and other comprehensive incomes. Let me start with that one first. Now, statement of profit or loss is it is almost the same way that you used to prepare an income statement or a statement of profit or loss in the financial accounting subject. It is almost the same, except a few things that are changing. There are some few rules that we need to change, and those are the ones I want to talk about now. So when you are required to prepare this statement, don't write. When you are required to prepare a statement of profit or loss, let me go through how to do it for publication. I am borrowing almost the same thing you used to do in your financial accounting when you are preparing this statement of profit or loss. But for now, we want to apply the rules as per the publication, for publication purposes. So always you have to start with the sales. Find out what are the sales of that company. From the question, find out the sales of that company. Then, listen, whenever you used to prepare income statement, you as a student for financial accounting, of course, you know, you had to come and say less cost of sales. You had to come and say less cost of sales. Now, listen, in your financial accounting, you had to determine the cost of sales. You had to take the opening stock, you remember, you had to add the purchases, and you had to minus closing stock so that you get the cost of sales there, and you had to push it to the extreme. Listen carefully. So that is how you used to do in financial accounting now. But now, when you are required to do this income statement for publication purposes, the rule is this. You do not, listen to this now, you do not show the workings, you do not show the workings of the cost of sales on the face of the income statement. No, you are not required to show the workings of the cost of sales on the face of the income statement. Instead, do that calculation somewhere, then bring it as a single amount. Bring the amount of the cost of sales as a single amount in the income statement or in the statement of profit or loss. Whatever the figure you will get, bring it as a single amount. That's one important point you should remember for publication purposes. Then you get the normal gross profit now. You get the normal gross profit, whatever you get. Then, listen, in your financial accounting, once you got the GP, you had to minus the expenses. You had to minus the expenses. But listen to this now, important point. When it comes to income statement for publication purposes, now, listen, you don't just list the expenses by their name. You don't come and minus electricity, water, telephone, insurance, depreciation, and so on. Listen, no. For publication purposes, if you are doing this statement for publication purposes, listen, you are required to classify, listen, you are required to classify all the expenses according to the function they perform in the business. You classify all the expenses according to the function that they perform in the business. One of the functions that may be performed in a business is the administration function. So all the expenses that you as a company you think are of administration in nature, combine them somewhere again and bring them here. Now you come and see your admin expenses. Again, you bring it as a single amount. You combined all of your admin expenses somewhere, and of course, now you are getting the total and bringing it as a single amount, Of course, you know examples of admin expenses. When you pay electricity of the office, we use office for administration. When you pay salaries to the office workers, when you pay electricity of the office, insurance of the office, and so on. So any expense that is related to administration, then you combine it somewhere and bring it as a single amount. Then another function that may be performed in an organization is what we call the selling and distribution function. Again, combine all the expenses that are of selling and distribution in nature, combine all of them somewhere and bring it again as a single amount. So you can come and say here, distribution expenses. Whatever it is, you minus. Good. Now, listen. Once you do that, now get the net amount. That net amount is what we shall be calling profit from operations. That's what we shall be calling profit from operations. Once you get the profit from operations, we shall be coming and charging here what we call finance cost. What we call finance cost. There are many examples of expenses that can be classified, or items that can be classified as a finance cost. Maybe for the sake of just asking you, please chat and tell me one example of a finance cost. What is one example of a finance cost? Chat and tell me, what do you think could be one example of a finance cost? Chat and tell me and give me one example of a finance cost. One example of a finance cost. Chat and give me one example of a finance cost. Chat, you chat on your live chat and give me an example of a finance cost. Chat. Good, thank you. Thank you, Peter. Now, so one example of a finance cost is what we call interest. Interest expense. This could be interest on loans. This could be interest on debentures and so on. Your cost of borrowing. Listen, your cost of borrowing finances, that example of the cost is interest. We shall discuss, listen, we shall discuss another example of finance cost later. But that's not the only one. There is another one which I'll discuss in details a short while from now. But let me assume for now that you have managed to identify the finance cost, whatever figure it is. I'm assuming you have managed to identify it, you minus. Then after you have got finance cost, ordinary shares, no. Ordinary shares, no. Nixon, no. Ordinary shares are part of capital. That's finance capital. Okay? And the ordinary shares are what we call equity. They are part of equity. Okay? But let me move on. After finance costs, we normally come to what we call investment income. Assuming your company has earned some income from its investment. Maybe your company has invested somewhere and they're earning what we call investment income. This investment income could be in form of dividend received. Maybe they have bought some shares as a company. You have bought some shares in a company somewhere else, and those shares are giving you some dividend as an income. Alternatively, you could have put some money, listen, you could have put some money in a fixed deposit, which is earning you interest. Or you could have bought some investments which don't give you dividend, but instead they give you interest. Like when you buy treasury bills, treasury bonds, they earn you interest instead of dividends. So even interest income or interest received is another example of an investment income. Whatever it is, we earn. Then we get the net there. We get the net, and that net is what we shall be calling profit before tax. Profit before tax. Good. Once you get the profit before tax, now you come and less what we are calling tax. Now listen carefully under tax. For tax, you could have what we call current tax, whatever it is. Some books will call it corporation tax, like in financial accounting. Maybe you are calling it corporation tax, whatever it is. Then you may have a question which has what we call deferred tax. What we have as deferred tax, we shall discuss that in a short while again, whatever it is. Now listen, for deferred tax, there are times you add it to the amount of the current tax, and there are times you deduct it from the amount of the current tax. When it comes to deferred tax, I have said there are times we shall be adding it to the amount of the current tax, and there are times we shall be deducting it. That is something we shall discuss in details a short while from now. Once you get those two, maybe you are adding the two or subtracting one from the other, you get the net. That is what we call the net the net or tax expense, the tax expense, whatever it is. Then once you get it, you minus, and you get what we call profit after tax. You get what we call profit after tax. Profit after tax. Now listen. Now listen carefully. When it comes to an income statement, or what we are calling statement of profit or loss, for publication, listen, for publication purposes, you do not continue from here. Listen carefully. You do not continue from here the way you used to do it in your financial accounting or foundation level, or if you did section 1 of section 1. No. Listen, you don't continue what you used to do. When you are doing this in financial accounting, after you got, I'm just reminding you, after you got the profit after tax, you remember you used to do the appropriation of this profit. In a company's account, you had to appropriate this profit. How? You had to minus what you call dividends, whatever it is. Whatever it is, you had to come and say transfers, maybe to general reserves, you remember. You had to get what you used to call retained profit for the year. You remember, you had to add what you used to call retained profit brought down. Retained profit brought down, whatever it is. Then you had to get what you used to call retained profit carried down. Retained profit carried down. Listen, that's how you used to do it in financial accounting. Or, listen, or when you are preparing your income statement for internal reporting purposes, then you can complete the income statement. You can complete the income statement. But when you are required to prepare this income statement for publication purposes, listen, then all these appropriations now, all those appropriations should not be done. Listen carefully. They should not be done in the statement of profit or loss. That means they should not be done in the income statement. All the appropriations are normally done elsewhere. And that elsewhere is in the statement of changes in equity. We have said one of the components that should be included in a complete set of financial statements is a statement of changes in equity. So that's where, and many other things we shall be doing, that's where you now do this appropriation of the profit. Otherwise, now that we are preparing an income statement for publication purposes, listen, I have told you that once you get the profit after tax, you don't do the appropriations. Listen, up to that point now, you have prepared what we call the statement of profit or loss, or what simply you can call an income statement. But you may be required to prepare what we are calling statement of profit or loss and other comprehensive incomes and other comprehensive incomes. Now listen. So once you get this profit after tax, then if your company has what we can call other comprehensive income, that's when now you come and bring in other comprehensive incomes. Other comprehensive incomes. Let me explain. Any gain, listen to this, any gain that your company could have made, but the rules of that gain does not require you to take that gain to the profit or loss. A company has made a gain, but the rules of the gain do not require you to take that gain to the profit or loss. Then that gain is what can be classified as an example of other comprehensive incomes. Let me give an example. Your company has an asset, let's call it land, for example. This land has a book value of, let's say, 100 million. During the year, your company revalued. During the year, your company revalued this land to its fair value, maybe 120 million. Or in other words, we revalued it upwards to by an extra 20. If you revalue this land by an extra 20, the rule of course will be you will debit land by 20, you will credit which account? Listen, you will credit an account called revaluation reserve. That's what you used to do. You debit asset and you credit revaluation. We normally don't, listen, we normally don't debit asset and credit P&L or profit and loss. As much as it's true, that 20 is a gain. The rules of accounting do not require you to take that 20 to the profit and loss. No. The rule says you take it to an account called revaluation reserve. But the question is it a gain to the company? The answer is yes. The answer is yes. Now that's a gain, and we can't show it on the face of the income statement like we have done for the others. Now we are required to show it as part of other comprehensive incomes, as part of other comprehensive income. So one example of other comprehensive income here could include gain on revaluation of fixed assets, gain on revaluation of fixed assets, or what you can call non-current assets. When you revalue your non-current assets like machinery, motor vehicle, land, buildings, you normally don't debit land and credit P&L. No. You normally debit land and credit revaluation reserve. But is it a gain? Yes. It could be that we could have revalued this land downwards. Still, when you revalue the land downwards, it's a loss. So I would have credited land by 20. I would still have debited revaluation reserve or machinery, whichever it is. I would have debited land. I would have debited revaluation reserve, credited land, or whichever other asset. So if it's a loss on revaluation of a fixed asset, then you put it in bracket. But as much as it's a loss, you don't take it to the P&L account. No. So we are saying whenever you revalue a fixed asset, whatever the gain or loss on revaluation, the rules of accounting says you take it to the revaluation reserve. So that's one example of an item that can be classified as part of other comprehensive income. Another one. When you as a company, you undertake, listen, when you as a company, you undertake what we call foreign currency transactions, you are likely, listen, you are likely to be required to translate because you'll be transacting. When you are transacting, you will be required to translate your currency from your transactions from one currency to another currency. In the process of translating one currency to another currency, automatically you may gain or you may lose. Listen, why? Because of the fluctuations in the exchange rate. Because of the fluctuations in the exchange rate. Let us assume you bought something from America at $1 and you bought it on credit. That time when you bought, you had not paid. But that time, 1 Kenya shilling or $1 was equivalent to 100 Kenya shillings, I'm assuming. So as per your books, listen to this now, you don't show a liability of $1, you will show a liability of 100. Yes, you bought something in $1, and that's how Americans are charging you, but you must convert. And say, in your books, you can't record dollars, you record Kenya shillings. So you record 100 shillings. Suppose the time of payment comes. Suppose the time of payment comes. And at the time of payment, $1 is equivalent to 95 shillings. So when you are going to pay, you are not going to pay 100 shillings. You're going to send 95 shillings so that it can be converted into $1. Remember, you still owe the company $1. But by the end of the year, $1 is equivalent to 95 shillings. So as a company, you will pay them 95 and you have already cleared their debt. But when you are buying these goods, you owed them 100 shillings. So there's a difference of 5 shillings. That does not mean that you owe the company 5 shillings. No, you have already paid them their debt. But that 5 shillings came because of the differences in the exchange rates. That means the fluctuations in the exchange rate. Is that a gain to you or a loss to you? That is a gain to you as a company. What if by the end of the year, $1 was equivalent to 105? You bought something at a time when $1 was equivalent to 100. You did not pay that time. When the time of payment comes, you are now told $1 is equivalent to 105. So you will have to look for, you as a company in Kenya, you will have to look for 105 Kenya shillings instead of 100. Remember, you are still paying $1. So again, like in this case, you stand to lose that extra 5 shillings. So there could be gains or loss on translation of foreign currency transactions. Whenever you have a foreign currency transactions, that gain or loss on translation, you have, listen, I may not talk about all of them now, but those gains or losses, there are some of them you may be required not to take them to the income statement, but they are gains. So we are saying any gain, we call that 5 shillings. We call that 5 shillings, whether it was a gain or loss, we normally call it an exchange difference. Whether it was 100 and you are supposed to pay 95, there is an exchange difference of 5, which is a gain. Now we are saying, in this case, you're supposed to pay 100, but now you are required to pay 105. So there is an exchange difference of 5, which is a loss. So whatever is the difference in the exchange rate, we normally refer to it as the exchange difference. So another transaction that can be classified as part of other comprehensive income is what we call exchange difference on translation. Exchange difference on translation of foreign currency transactions. Foreign currency transactions. If it's a gain, of course you add. If it's a loss, you minus. For now, listen. For now, let me assume those are the only 2 other comprehensive items as per the questions. Get the totals, and now you get what we are calling total comprehensive incomes. Total comprehensive incomes. Sawa, good. So I've taken you through, listen, I've taken you through in an overview, not in details, in an overview of how to prepare a statement of profit or loss and other comprehensive income, or what some questions will call statement of comprehensive income, or what I've told you, some questions will call it income statement, whatever the examiner will call it, so long as it's a question on published account. How do you prepare the income statement or the statement of profit or loss? Good. So let me go through it once more before we proceed. I've told you, you start with the sales. I've also told you, you come and bring in the cost of sales. I've told you, one key important point about cost of sales is don't show the workings of the cost of sales on the face of the income statement. No. I know you know how to get cost of sales, that we always take opening stock, add purchases, less closing stock. True, but that working should be done elsewhere and brought in now as a single amount in the income statement or in the statement of profit or loss. Once you do that, I've said you get the normal gross profit. Then again, I've told you, we normally, once you get the GP, we normally minus expenses. I've told you that for expenses, when it comes to publication purposes, for publication purposes, all expenses must be classified according to their function. They must be classified according to their function. I have said what are the kind of functions. One is the administration function. So I've told you, combine all the expenses in your company which are of administration in nature and bring the total as a single amount in the income statement. So the total working, you are doing it elsewhere. The other function I have told you is what we have called selling and distribution function. Go again, work it out somewhere, bring it as a single amount, bring it as a single amount. That is selling and distribution expenses. Some books will just call it distribution expenses. Then I've told you, you get the profit from operations. I've told you, you minus finance costs. I've just given you one example of finance costs, and that is interest. Then the other one is what we have discussed. I've said I'll talk about another example. I'll talk about another example of finance costs in a short while. Then I've said after you have done that, you bring in investment income. Then I've told you, get the profit before tax. Then I've told you, you minus the tax expense. To get the tax expense, there are various components that can be used in the determination of the tax expense. One of them, which will obviously be there, is the corporation tax, or what your question could call the current tax. Okay. Then I've told you, sometimes your question may have what we call deferred tax. I've told you, when it comes to deferred tax, there are times we shall be adding that amount of deferred tax to the current tax, or there are times you will be deducting the amount of the deferred tax from the current tax. We shall discuss that in a short while. Once you do that, get the net of those two, and that becomes your net or your tax expense. Then you minus from the profit before tax, and you get your profit after tax. I have told you, once you get the profit after tax, then you are through with the income statement for publication purposes. I've told you, do not show the appropriations of that profit in this income statement. No. Those appropriations, I've told you, should be done in the statement of changes in equity, as we shall see later. As we shall see later. Good. Then I've told you, if the question is asking you to prepare statement of profit or loss and other comprehensive income, or they just say statement of comprehensive income, then you now come and show other comprehensive incomes, whichever they are. I've given you two examples: gain or loss on revaluation, 2, exchange difference on translation of foreign currency transactions. Good. Now, so I'm through with that. Maybe before I go into the details of some of these items in the income statement, let us now put down what we have said so far. Let us put down what we have said so far. So put down the topic, put down the topic. The topic is called published accounts. Put down the topic, and the topic is called published accounts. The topic is called published accounts. And you say this: put down this. The following are the components. The following are the components that should be included. The following are the components that should be included. The following are the components that should be included in a complete set The following are the components that should be included in a complete set of financial statements that should be included in a complete set of financial statements for publication purposes. For publication purposes. For publication purposes. For publication purposes. Number one. Statement of financial position. Statement of financial position. Number two, statement of profit or loss. Statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. And other comprehensive income. Number three, statement of changes in equity. Statement of changes in equity. Statement of changes in equity. Number four, statement of cash flows. Statement of cash flows. Number five, accounting policies and explanatory notes. Accounting policies and explanatory notes. Accounting policies and explanatory notes. Then you see this, another paragraph. The following is the format. The following is the format of the statement of profit or loss. The following is the format of the statement of profit or loss. The following is the format of the statement of profit or loss. I don't think I could rub much. I might do rub. Let me just rub so that we go together slowly. So let me rub here so that I take you slowly one by one now. We write it slowly together. Okay. So let's put down that statement now. Let's put it together now. Statement of profit or loss. I have told you, you start with the sales. Whatever the question will give you, pick it. Then I've told you, you come to cost of sales. I've told you, don't work it out on the face of the income statement. Work it out somewhere. Bring it as a single amount. Whatever it is, get it. Then I've told you, get the gross profit or the GP. Then I've said, you come and now minus expenses, one of them being the admin expenses. Get it somewhere again as a total of all your admin expenses. Okay. Then I've talked about distribution expenses. Find out from the question or work out in total what are all your distribution expenses. Good. Then I have told you, get the net, and that net is what I called profit from operations. Profit from operations. The other one is, I've told you, once you get the profit from operations, you come to finance cost. I can put in bracket interest expense. Interest expense. For now, just say plus. We shall discuss that later. Just say plus. Whatever it is, we shall discuss. Some of you are already aware, I think so. Some of you may not be aware of what other example, but it's something I'll talk about later. How much or what else can be an example of whatever it is. But now, for now, I'm just assuming we know it. Get the total. So there's something there we shall add. Okay. Next, I've talked about investment income. Investment income, I've said this could be in form of dividend received or interest received. Dividend received or interest received, I told you add. Get what we were calling profit before tax. Profit before tax, maybe I could put it in full. Profit before tax. Then I told you, you minus the tax now. You come and say less tax. For tax, I've already told you, you have what we call current tax. Put it on the inner column, put it on the inner column. Then I've told you, you may be required to adjust it with what we call deferred tax. I've told you there are times you add, there are times you minus, depending on the question, the way it has been set. We shall discuss that in a short while, how to determine whether to add or subtract the deferred tax. Then I've told you, get the net, you minus. Then get what we have called profit after tax. That is profit after tax. Good. I've told you, if you are doing a question on published accounts, once you realize there is a question on published accounts, you don't do the appropriations of the profit in this income statement. No. Good. Then from there, I've told you, now you come to other comprehensive incomes. Other comprehensive incomes. Other comprehensive incomes. We have already given two examples. One of them is what we have called gain on revaluation. Gain on revaluation of fixed assets. Gain on revaluation of fixed assets, whatever it is. Then I've talked about exchange difference on translation. Exchange difference on translation of foreign currency transactions. Whatever it is, that's an example I've given. Then you get the total, and that total is what we have called total comprehensive incomes. Good. Total comprehensive income. Total comprehensive income. Good. So finish. I go back and discuss a few of the items there in details. So finish. I discuss some of those items in details now. Okay. Okay, I hope you are through now. I hope you are through. First, let me also know, by the way, is the sound loud and clear? Chat and tell me yes. I also need to know, is the sound loud and clear? Is the sound loud and clear so I know? Chat and say yes or no. Is the sound loud and clear? Chat in the live chat. Tell me yes or good. Thank you. Sawa. So we can now continue. Thank you. We can now continue. Okay, so let me take you back. Another thing we want to discuss is this. We want to take you back. I want to discuss this item I've called interest. I want to discuss that item I've called interest expense. How do you determine it? Now, listen. When it comes to interest, how much interest you take to the income statement, that's not a new concept to you. You must have done it in financial accounting, and especially when you are doing the topic of company accounts. Let me test you now and ask you to remember what you did. Now listen. In your financial accounting, especially when you used to do company accounts, you used to be given a trial balance. Let me assume you used to be given a trial balance of this nature. In that trial balance, you are given 10% debentures. Let me assume 500,000. In that same trial balance, you are given interest on debentures, an amount of 40,000. Then let me assume you got the totals of the trial balance, whichever it is. I'm only showing the relevant part. Now tell me this. When the examiner used to give you such a trial balance, and he required you to prepare the profit and loss or the income statement for the company and the balance sheet for that company, listen, then tell me, how much were you taking to the profit and loss as the amount of the interest? How much were you charging in the P&L account as the amount of the interest? Look at that illustration. And chart and tell me that as much as you can remember, we used to charge this much. When I'm given such a scenario, I charge this much to the income statement. So you chart and tell me what you remember, not what you remember, what you know should be charged in the income statement. Tell me what should be charged in the income statement whenever you are given such a trial balance. This is not new. I am only asking you to remember what you used to do in financial accounting. I want to apply it. So it's a common thing even in published accounts to be given a trial balance with such items. So my question is, when you are given such a trial balance and you are required to prepare an income statement or profit and loss, in that income statement, how much were you charging as interest? I am waiting for you to chat and give me the answers. I want to see different opinions. Most of you have told me, yes, you're able to hear the sound, you're able to hear the sound, you're able to hear the sound. Now give me your answers. As many as I've already answered their yes question, do the same for this. I'm saying it's not a technical thing. You used to do it in financial accounting. It's not technical. I'm only using it to apply to published accounts, but you have done it. So when you are given a trial balance of this nature, how much do you charge to the income statement or to the profit and loss as the interest expense? How much? Ivan, I'm waiting. Don't write a long statement. I just want a figure. I just want a figure. I just want a figure. Yes, somebody. Ay. You can't tell me all of you have forgotten. No, it can't be possible. It can't be possible that all of you have forgotten. No. I'm waiting. Maybe I'm not communicating. Maybe I'm the one not communicating. I'm asking you, when you are given a trial balance of this nature, and you are required to prepare a trial balance, no, you are required to prepare, an income statement or a profit and loss. How much do you charge as interest? Yes, somebody? I expect some answers, Nani. I expect. Somebody else? Somebody has given us 5,000. Somebody else? Somebody else? Somebody has said 5,000. Somebody else? We shall find out. Don't panic. Just a matter of testing whether you can remember, but it does not mean that even if you are wrong, 50,000. No, you have repeated again, 90. Somebody else? What do you remember? 50. Okay, let me take it now. Listen carefully now. Every time you used to do an income statement, there is a rule that applies whenever you are doing an income statement. Thank you. Now listen to your solution now. Thank you. Listen to your solution now. I'm saying this. Every time you did or you do an income statement, whether it's a sole trader, whether it's a partnership, whether it's a company, there is a concept we call accrual concept. I do hope you still remember. That concept states that whenever you are doing an income statement or when you are preparing your final accounts, you are supposed to recognize costs when they are incurred, but not when money was paid. You recognize costs when they are incurred, but not when money is paid. That's the rule that's the requirement of the accrual concept. It says that as a company or as a business, you should recognize costs when they are incurred, but not when money is paid. You also recognize revenue. If it's a revenue, you recognize revenue or income when it is earned, but not when money was received. You recognize revenue when it is earned, but not when money is received. Good. Now listen. So ours, we are dealing with a cost. Interest is an expense. And the concept states, you recognize costs when they are incurred, but not when money is paid. Listen now. This company has a 10% debenture amounting to 500,000. Therefore, as a company, you are required every year to be repaying your debenture at an interest of 10%. So you're supposed to pay your debenture holders interest at 10%. What is 10% of 500? 10% of 500 is 50,000. That 50,000 is the charge for the year, whether you have paid it or not. That is the charge for the year. And so, listen, when I'm doing the P&L account for the company or the income statement, I should charge 50,000. In other words, I recognize the cost when they are incurred. From this trial balance, I can see we have only paid 40,000. for interest. We have only paid, as a company, we have only paid 40,000. But we don't take to the income statement what you have paid. No, you take to the income statement the charge for the year. And the charge for the year is 10% of the value of the debenture. Now listen. So in the income statement, we are charging 50. But I can see from this trial balance, we have only paid 40. We were supposed to pay 50, but we have only paid 40. So there's another balance of 10, which as a company, you have not paid. That 10 million or 10,000 is what you owe to your debenture holders. So when you are doing your balance sheet now, when you are doing the balance sheet for this company, listen, among the current liabilities there, then as a company, you should show what we are calling debenture interest owing. Debenture interest owing of 10,000. Good. So some of your questions, even in published accounts, come that way. Where you have only paid part of the debenture interest. You have only paid part of the debenture interest. Other times, listen, the examiner could set a question and it gives you a trial balance of this nature. Again, in that trial balance, you have 10% debentures amounting to 500. Then, that's all. From that trial balance, I can't see interest. Does it mean, listen to this, does it mean that I'm not going to charge interest? The answer is no. You still must recognize interest. I've told you, the accrual concept states you recognize costs when they are incurred, but not when money is paid. So according to this trial balance, we have paid nothing for interest. But are we supposed to pay? Yes. Every year the debenture holders are entitled to 10% of their money as interest. So it means when I'm preparing the profit and loss for the company, I must charge interest, or again 50,000. 10% of the value of the debenture is the amount of interest. So it means, listen, it means when I'm preparing the income statement or the profit and loss, I don't even need to bother. I don't need to bother as a company. We don't need to bother whether we have paid interest or we have not paid interest. We don't even need to know. When you are doing the income statement, you charge or you recognize the cost when it is incurred, the charge for the year. Whether you have paid that charge or you have not paid, recognize that charge for the year. Listen, it is only when you are doing the balance sheet that's when you get concerned as to whether you owe the debenture holders anything or you owe them nothing. Like in the first case, I owed them 50, but I'd only paid them 40. So when I'm doing my balance sheet, I need to be concerned. Have I paid them anything? Yes, I paid them 40, but I'm supposed to have paid them 50, so I owe them 10. So I took it to the balance sheet as a liability. In this second case, I am supposed to pay 50. That is what I charge in the income statement. That one, there's no question about it. When I'm doing the balance sheet now, I'll ask myself, do I owe my debenture holders anything? Of course, you are supposed to pay them 50, but according to the same trial balance, you have paid nothing. You have paid nothing at all. So the same 50 will automatically go to the income statement as an expense, and the same 50 will go to your balance sheet now as a liability. Again, among the current, you will have their debenture interest owing. Debenture interest owing of 50,000. So I hope now you know how to treat debenture interest, or in other words, interest. It could be loans, it could be on debentures. It does not matter. But the point I'm trying to say is, how do you determine the charge for the year for interest? Now, our case number one is a scenario, listen, Our case number 1 is a scenario where part of the interest had been paid. Number 1, this case 1 was where part of the interest was paid. That is case 1. This second case is where we are dealing, number 2, case 2, where no interest was paid. Where no interest was paid. Where no interest was paid. But I've said, whether you are paid or not, when it comes to income statement, they don't care. What is the charge for the year? That's what they must recognize. Good. So some of your past paper questions in published will be set as per case 1, and some of them will be set as per case 2. So one must be very careful. In any published accounts question, either it will be debentures as case 1 or debentures as case number 2. So let's put down something now. Let's put down something on what we have already said. So have another subheading, and you call it this way, treatment, treatment of debenture interest. Treatment of debenture interest. Treatment of debenture interest. That's a subheading. Treatment of debenture interest. Treatment of debenture interest. Then for the purpose of that, you can have another case, and case 1. Call it case 1. Then you say where part of the interest is paid. 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 Then just show like you are preparing that trial balance. Just show like you are preparing that trial balance. Have a column of the debit. Have a column of the credit. Then you come and like show 10% debenture. Put the amount as 500,000. Then you come and show in that same trial balance. Show that interest on debenture 40. Then you show like you are closing the trial balance. Show like you are closing the trial balance. Then below that, you come and say P&L. You come and charge that 50. I have told you it is 10% of 500,000. Just to remind you how I'm getting that 50. It is 10% of 500,000. That is the charge, not what you have paid, the charge for the year. Then you come and show there down, balance sheet, or what you normally call statement of financial position. So among the current liabilities you will have in your balance sheet, among the current liabilities you will have debenture interest owing of how much? 10,000. I'm supposed to pay them 50. I've only paid them 40. So I owe them another 10. That 10 is what you take to the balance sheet as a liability. Okay? Good. So finish. If you are through, we want to go to case 2 now. So for those who are through, andika case 2, where no interest is paid. Number 2, andika where no interest is paid. Where no interest is paid. Where no interest is paid. Then you can show again as if you are preparing that trial balance. Show as if you are preparing that trial balance. In that trial balance, you have a 10% debenture. again amounting to 500. Then you show like you're closing that trial balance. Then below that, you come and say interest in the P&L account. What do you charge as interest? I've said whether you have paid or not, you should still charge 10%. That is 50,000. 50,000. Then I've told you in the balance sheet, show a liability. According to the trial balance, we have paid nothing. But what were we supposed to pay? 50. Have we paid it? No. So the whole amount of 50 becomes the charge for the year, and the whole amount of the 50 becomes the liability for the year. Good. So finish. I now touch on something else. Finish. I touch on something else now. I hope you're through now. I hope you're through now. I hope you're through now. Let me go on. I want to discuss something else. I want to discuss something else now. I hope you're through with the copying. Okay, fine. So let me discuss the next item. Now listen to this. Again, it's not something new. Now listen. Whenever a company wants to raise finances, listen to this. Whenever a company wants to raise finances, one source of finance is that the company can issue what we call preference shares. Your company can issue what we call preference shares. You also know from your accounting knowledge that preference shares can either be what we call redeemable preference shares, or your company may issue what we call irredeemable preference shares or non-redeemable. Let's just call them non-redeemable preference shares. Non-redeemable preference shares. I know you know the difference between redeemable and non-redeemable. So, first, let us assume the company wanted to raise 20 million shillings as finance. So, Company A, listen, Company A issued a 10% redeemable preference shares amounting to 20 million. That was Company A. Company B, to raise the same 10 million, then they decided to issue a 10% non-redeemable preference shares worth 20 million. So the question is this. Listen to this. When these two companies are preparing, for example, their balance sheet, will they take the 20 million in their balance sheet in the same place where Company A took their 20 million? Is it the same place where Company B will take their 20 million? I want to see yes or no. When the two companies are preparing their balance sheet, where Company A will take their 20 million in the balance sheet, is it the same place where Company B will take their 20 million? I want to see yes or no, just to see whether you can remember. Is it the same place? I'm not asking you to give me the reason. I'm asking you to tell me yes or no. Caroline says no. What is somebody else's opinion? Caroline says no. Somebody else's opinion? No. Alfred says no. Sawa. Now listen. It's true that they don't go to the same place. Now listen carefully. I may not ask you, because of time, I may not ask you what's the difference between the two, but I want you to listen. 10 years ago, your company A wanted to raise finances. So they issued a 10% redeemable preference shares. Now, company B again, 10 years ago, they wanted to raise finance. So they issued a 10% non-redeemable preference shares. Now listen. Of course, you know, as a student, you know that if your company issued a 10% redeemable preference shares, then those are shares that can be redeemed back. You as a company, listen, you as a company, you can buy back your shares. Redeemable means you can buy back those shares. So 10 years ago, when you are issuing the shares, you told the shareholders, listen, you told the shareholders, a time will come in the future, I will have to pay you back your 20 million and you bring back my share certificate. So you have, listen, it means you will be required to pay back that 20 million. But for company B, when they were raising the 20 million 10 years ago, do they have an obligation to pay the 20 million in the future? No. They don't have an obligation to buy back those shares. Now listen. So you as company A, when you issued your redeemable preference shares, that same day you issued the shares 10 years ago, you incurred an obligation to do what? To pay back the 20 million. To pay back the 20 million. But company B had no obligation to pay back the 20 million. Now, because as a company, you have an obligation for company A, because they had an obligation to pay back the 20 million in future, then listen, that 20 million of the redeemable preference shares, you don't take it, listen now, you don't take it to the balance sheet as part of capital. You don't take the 20 million to the balance sheet as part of capital. No. You will take it to the balance sheet as a liability. Of course, it is a long-term liability. Why? Listen. Just like you know, whenever a company issues debentures, these debentures normally go to the balance sheet as a long-term liability, or what you call non-current liabilities. They go to the balance sheet as a non-current. Why? Because as a company, you must pay back that amount of the debentures to the debenture holders. So you normally take it to the balance sheet as a liability. So if you issued your 10% debentures, like we were assuming, 500, you will take your 500 to the balance sheet as a liability. Listen now. Same to the redeemable preference shares. You don't take them to the balance sheet as part of capital. No, you will take them to the balance sheet as a long-term liability. So that 10% redeemable preference shares, that should go to the balance sheet. That 20 million will go to the balance sheet as a long-term liability. The reason being, this company that issued them, it has an obligation of paying back that amount. For company B, they did not have an obligation to pay back. So for them, where you have capital, which is among the equities, where you have ordinary share capital, share premium, there in the balance sheet, retained profit, there you can now bring in the non-redeemable the non-redeemable preference shares worth 20 million. So in other words, we are saying for the non-redeemable preference shares, they are considered as a component of equity, together with other forms of equity like share premium, share capital, maybe retained profit, revaluation reserve, general reserve. Now, there you will have a 10% non-redeemable preference shares amounting to 20. So, listen. So I've just talked about one key difference on the treatment of these two preference shares in the balance sheet. That if you find out from the question that your company has in their trial balance a redeemable preference share, then when you are preparing the balance sheet, don't take it as part of equity. Take it as a long-term liability. Are you there? Good. If your company has a non-redeemable preference share, take it to the balance sheet as a component of equity among the share capital, share premium, general reserves, and so on. Good. Another key important point. Listen to this now. Another key important point. Each of these two companies, every year, they will be required to pay preference dividends of how much? 2 million. Every year, they're supposed to pay 10% of the preference, 10% of the preference as dividend. Company A, 10% of 20 million is 2 million. Company B, 10% of 20 million is another preference dividend again of 2 million. Listen, so both of them are still going to pay dividends of 2 million. But what is but? Will the two companies treat the same dividends, this dividend, in the same way? The answer again is no. Listen, the answer again is no. These dividends for company A and B will not be treated the same way in the income statement. No. Now, the second one is for the non-redeemable. The dividend on the non-redeemable preference, non-redeemable. I hope you are listening. The dividend on the non-redeemable, that will become an appropriation of profit. Where you normally say, and you used to do it, you got profit after tax, you have to minus the dividends. Then minus transfers to reserves. Get the retained profit for the year. Add retained brought down. That section of the income statement, that's where you used to take this second one. The preference dividends on non-redeemable preference share, their dividend is an appropriation of profits. Of course, I've told you, for publication purposes, we don't do the appropriations in the income statement. You do them where? I've told you, you do them in the statement of changes in equity. Okay? Now, which is the same appropriation, it's only that you are doing it somewhere else. But the question is, what about the preference dividends on redeemable preference share? That 2 million. That's what I want you to listen carefully. Before I talk about how to treat that 2 million, I want to take you back. When you as a company, when you issued your 10% debentures amounting to 500, you was to pay debenture holders interest of what? 50. We have discussed that. That 50 is what we said is a finance cost. It's a finance cost. The cost of borrowing through debentures is the interest you paid to the debenture holders. That 50. and we took it, that 50, when I was looking at the income statement format, I took it as part of finance cost, as interest here, that 50. That 50 interest, that is there it is. Now, listen carefully now. Now that we are also paying preference dividend on redeemable, listen, on redeemable preference shares, and I've told you, redeemable preference shares are not or is not part of equity. It's not a capital. It's a liability. It's part of finances. In other words, you borrowed, just like you borrowed through issue of debentures, you borrowed again by issuing redeemable preference shares. Now, because you borrowed by issuing redeemable preference shares, the cost of borrowing through the issue of redeemable, that 2 million on redeemable preference shares, listen, again, it should be considered as a finance, listen, it should be considered as a finance cost, not as an appropriation of profit. No. So when you will be doing the income statement for the company, listen, and you realize that the trial balance question gave you a 10% redeemable preference share worth 20 million, then the preference dividend on redeemable preference shares, that 2 million will also be considered as a finance cost, not an appropriation of profit like the other one. I hope that has been understood. How, listen, how to treat redeemable preference shares and non-redeemable in the balance sheet. We have agreed for redeemable in the balance sheet, long-term liability. Why? Because as a company, you have an obligation to pay back. 2, for non-redeemable, it's an it's part of equity. For non-redeemable, it's part of equity in the balance sheet. Then we have discussed how do we treat their dividends. I've told you, for preference shares, if they are redeemable, then the preference dividends on redeemable preference shares, their dividend is classified as a finance cost for redeemable preference shares. While for the non-redeemable, the dividend is considered as an appropriation of profit in the statement of changes in equity. I hope you have understood that now. Good. Now, we don't have time to put down the summary notes on that. That's what I'll do next time. I'll give the summary notes on that statement of preference shares but just what I want you to do, listen, I want you to write just down the subheading so that I know where to pick it up from. Just put down the subheading and it treatment of preference shares and preference dividends. And you to somewhere preference shares, treatment of preference shares and preference dividends. That's what I'll discuss or put down as the notes next time. So I'll put down the notes next time, to give the notes next time. So for now, let me discuss something else. And I'm doing this for the new students. Now listen to me as the new students. For some of you, you may be interested. I said today was a free class. So some of you have joined us for the first time. And you may be interested in continuing with this subject called financial reporting of the intermediate level. We are dealing with financial reporting of the intermediate level. If you are interested in continuing with us for the rest of the syllabus, then listen, our classes are every Tuesday, Thursday, and Friday, like tomorrow. All of them from 8 p.m. to 10 p.m. For those who may not be available throughout, you can also buy what we call pre-recorded videos for the whole syllabus. You can buy what we call pre-recorded videos where you can listen to your videos at your own free time. If you don't have time to join the live class from 8 to 10 every Tuesday, Thursday, and Friday, you can buy also what we call pre-recorded videos. Okay? Now, even if you join the normal class, and assuming one day you miss a class, maybe on a Friday you are too busy, does it mean that that class is gone? No. Our system is such a way that you can go back to the group where the link was posted and be able to watch your video at your own free time. You can be able to watch your video at your own free time. Okay? That's what we're saying. So whenever you miss a class, you normally don't count you have missed it. You can listen to your video the following day, 2 days later, and so on. That is the system. Currently, for those who want to join, I'm charging 4,000 shillings, and it's acceptable to pay in installment. That's what I'm charging. Okay? You can reach me on this number, 0722 65 8875. 0722 65 8875. That is the number you can reach me. Now, for some of you, listen, you have friends who are doing the advanced level. So I'm also teaching a subject we call advanced financial reporting for those who want to recommend to their students or to their fellow students. For now, we are doing FR, but we also teach advanced financial reporting. For advanced financial reporting, we always have either early morning classes or evening classes. We have early morning classes or evening classes. Even for FR, advanced financial reporting, you can also still buy what you are calling pre-recorded videos. You can also buy pre-recorded videos if you are not available in the early morning or in the evenings. But the same system applies. In case you miss a class, you can still watch your video at your own free time. So if you have friends who are doing advanced financial reporting, you can recommend them also. For those who have students or friends who are doing the foundation level, I'm also teaching financial accounting. I'm also teaching the financial accounting of the foundation level. This is foundation level, or what used to be called section 1, and also for the ATD 1 and 2. There is also financial accounting there also. For financial accounting, ATD 1 and ATD 2, there are some students who are also doing CIFA, and they also have financial accounting. All of them, we are still charging 4,000 shillings. All of them, we are still charging 4,000 shillings for the whole semester. Again, it's accepted to pay in installment. Good. Before we leave, I've told you, everyone now, I've told everyone, please subscribe to my YouTube channel. Please subscribe to my YouTube channel, which is called CPA Joseph Njuguna. My channel is called CPA Joseph Njuguna. Just go to that channel and subscribe. You click the subscription button and also the notification bell to keep reminding you every time we post a new video. It will tell you that a new video has been posted. You may be interested in listening to it. So I think that's all I can say to the new students about our classes. For financial reporting, I've said Tuesday, Thursday, and Friday from 8 to 10. We are charging 4,000. You can reach me on 0722 658875. Call me even after this or tomorrow, whichever the day. I've told you, if you have friends who are doing advanced financial reporting, we also have classes either in the early morning or evening, or even somebody can buy what we have called pre-recorded videos for the whole syllabus. You get all of them at once. You listen to them at your own free time. I've told you, if you have friends who are doing financial accounting of the intermediate, you can also recommend them financial accounting of foundation, and ATD1 and ATD2 and also CIFA. Those ones we are teaching financial accounting also. Otherwise, let me say good night for now. See you tomorrow. For the new students, you can join us officially maybe from tomorrow if you want to join us. I don't know whether there's any question, especially maybe for the new students who can comment something. Any new students who was with us for the first time and he wants to comment something before we close the class for today? Any student who was new and they want to comment on something? So tomorrow I'll finish the summary notes on treatment of preference shares and preference dividends. Then I talk about more other things in the income statement. We are not through yet with the income statement. There is that deferred tax to talk about and so on. Okay. So if there is no comment, I was asking whether there's a new student who has a comment to say. Any new student who has a comment? Okay. So maybe we can stop there. We pick it up from there next time. Good. For those who are interested and they are new, call me on that number. Bye for now. Okay, good night everyone now. Good night. If somebody is asking notes, maybe the videos, not notes. Notes, I dictate them as I'm teaching the class. Maybe if you are joining the class and I can give you the videos for the branch. Videos for the branch, but not notes. Notes are dictating. I'm already dictating the notes as I teach, just like I've done today. Are you okay, Kamba? That notes I normally don't give. I dictate the notes as I teach, just like I've dictated the notes for today or published. So unless maybe you are a new student or you have just joined us, and maybe I forgot to give you the videos of the previous classes, we have already done branch. Maybe you need the videos. Maybe not the notes. The notes you have them. As I dictate as I did the question on branch, I did give you the notes. So as you are learning, the videos. You are already an old student in our class, I'll check. Just maybe chat me sideways. You chat me aside and remind me that maybe I never gave you the videos. If you are a student, remind me that I never gave you the videos for the branch accounts. Maybe you joined after we have already started. So I'll give you the videos if you missed if you joined after we have started, but I never gave you the videos. I can give you the videos. That's not a problem. Okay. I hope that's okay now. So maybe we can stop there. Otherwise, good night. Good night, everyone. Good night. Thank you.